The UK economy is in the worst state that it has been in since 2008.
It went down even further.
And investing towards our future seems like an impossible task. And if we don't figure out a way to pull together our finances, then our dreams of reaching our financial goals or reaching financial independence will be ruined. But I've managed to find a load of different ways that we can make the best out of a failing UK economy, and in some cases, even profit from it. Because behind all of the fear and the crashing and the financial graphs lay a few hidden gems that you need to know about, so that you can save your finances in these unprecedented times.
And where better to start than by tackling the monster that is inflation?
Phew. She's a big one. The latest figures have inflation sat at 9.9% in the UK. And with the way that our economics are being handled, who knows where it's going next?
I get it.
And this sets us back in a big way, because no matter what we do with our money, if inflation stays as it is, in a year's time, our money is going to be roughly 10% less valuable than it is today. In other words, £1,000 today would be worth £909 this time next year. And that is a nightmare. But it turns out that we could use it to our advantage. Because with inflation being so high, we can currently borrow money with an interest rate that is lower than inflation. So borrowing money can actually become profitable. Let me show you what I mean. If you have a £1,000 loan for 1 year with a 5% interest rate, if you make monthly repayments, you end up paying back a total of £1,027. But because inflation is gradually reducing the purchasing power of your money, the amount that you pay back ends up being worth £973 in today's money. So by the end of a loan period, you end up profiting £27 by being in debt. Weird, isn't it? Now, I'm not suggesting that you suddenly go on and take a load of debt to try and take advantage of this. I'm just saying that if you have low interest debt that is actually lower than the current inflation rate, then that's actually a good thing. The real problems start to arise when rising interest rates cause inflation to decrease, and then inflation becomes less than the interest rates that you're paying on your loans. But I have a solution for that later in this video.
But before we go into that, let's take a look at how we can make money from the banks whilst interest rates are on the rise.
Because the banks are literally laughing right now. And no, it's not because Quasi cut the cap on their bonuses.
I get it.
But because banks profit by taking the cash that customers deposit with them and investing it in short-dated government bonds, which pay a higher interest rate than the interest rate that they pay to their customers. With interest rates so high, the margins for banks are actually increasing, meaning they're getting more profit. So they are literally fighting for our money, and that puts us in the power position. This can be seen already as banks are offering higher interest rates on our savings. Different banks offer different deals, depending on how accessible you want your savings to be. Easy access savings accounts mean that you can withdraw your money whenever you'd like, but you typically get a lower interest rate because of that. Or there are fixed term deals where you have to lock your money away for a certain period of time, and because of that, you get a higher interest rate as a reward. The market is always changing, and I find the Money Saving Expert website the best place to keep up with it. A recent deal has come up with Barclays offering 5% interest on easy access savings, which is actually better than the best fixed term deal as I film this. So make sure that your bank isn't getting away with paying you tiny interest rates, as they don't deserve your money.
But the deals that we can get from the banks don't just stop there.
Some banks want your money so much that they will literally pay you to choose them as your primary bank. You normally have to use the current account switch service, which transfers your current bank account over to a new bank, including all your funds and direct debits. And the type of rewards that you can receive can vary, with some offering cash back on bills, discounts on insurance, overdraft offers, but the most popular are straight up cash bribes. As I film this, the best deal is £200 plus 5% at Nationwide, but that's with your savings locked away for a year. Now you can actually take massive advantage of this, switching multiple times between banks to earn a few £100. But just bear in mind that there are some terms and conditions, usually saying that you can't have been a member of a bank within the past few years or so, meaning that you can't just spam the offer. And you should be aware that opening a new bank account will require a search on your credit file. And if you have too many searches in a short period of time, that could negatively impact your credit score. This isn't always an issue, but if you want to lend money soon, then it may be best to keep your credit score as high as possible. But the offers that we've seen so far are only really good for standard savings, so we need to try and find the best solutions for making investments.
And with interest rates on the rise, there is a new investment that can guarantee a high rate of return.
And this comes from mortgage rates rising to higher values than what we've seen in previous years, with current 2-year fixed rate deals averaging 6.16%. So with a £250,000 mortgage with a 25-year term and an interest rate at 6.16%, you end up having to pay back a total of £490,000. But if you do have a mortgage, or any other loan for that matter, then making early repayments could massively decrease the total amount that you end up paying back. In this same example, the current repayments are £1,636 per month, but by paying back an extra £200 each month, you save almost 60k and reduce your payment period by 5.5 years. And this is because you eat at the interest part of the loan at a faster rate. which will mean that the mortgage will grow less over time, which is a big problem now because interest rates are so high. As we said earlier, early repayments don't necessarily make numerical sense whilst inflation is higher than the interest rate on your loan. But as interest rates start to exceed inflation, which they inevitably will, then making early repayments on high interest loans will become more attractive. And the best part about it is that it is essentially an investment that has a guaranteed rate of return. In our example, we saved 60k over a 19-year and 7-month period by paying £200 per month. So if we flip that round into an investment to make 60k profit over the same time period, we would require a rate of return of 7.5%. Now this number will vary a bit, depending on the mortgage amount and the length of the loan. But if we use this as an average example, then repaying your mortgage early can earn you a guaranteed rate of return of 7.5%. That is mental. And if you up the early repayments to £500 per month, that's an equivalent rate of return of 9.4%. As of May 2022, Vanguard forecast the average 10-year returns of global equities to lie around 3.6 to 5.6%. So if we can guarantee a rate of return that is higher than that, that's essentially a cheat code. But overpaying a mortgage does come with some downsides, including early repayment charges, which are going to eat into the amount that you save. We're going to get into overpaying mortgages more in the next video, so stay tuned. But what about if you don't have any debts? Are there any other investments that we can profit from in these desperate times?
Well, with the UK economy crashing so dramatically, we've been blinded to a solution that is right in front of us.
Because the stock market has been in decline for the entire year, with the S&P 500 down 24% year to date and global markets down 26%. As a side note, if you're a UK investor and you're wondering why your investments aren't down this much, it's because we invest in pounds. So our S&P 500 funds are only down around 7%, but the pound is down about 18% on the dollar, which kind of hides the damage. So when it comes to your investing strategy, there is something that you need to do to really take advantage of this, which is to do nothing. Sticking with a solid investing plan is absolutely vital during market downturns, so that you can keep getting money into the market as equity prices are falling. Because if we maintain a long-term investing mindset, then we shouldn't be fazed by a short-term fall in equity prices. When we look back in 10 or 20 years' time, we'll likely be thinking how much of a bargain investments were during this period, and you'll be glad that you stuck with the plan. Now is not the time to give up on your personal finances, or investing for that matter, as these are the most important periods that you'll face. It's easy to invest when the times are good, but true investors stick with it through the bad times too. As J.L. Collins said in his book, The Simple Path to Wealth, everybody makes money when the market is rising, but what determines whether it will make you wealthy or leave you bleeding on the side of a road is what you do during the times it is collapsing.
But if you're on a journey to financial independence, there's still one more thing that you need to consider.
Because there is a key investing concept that you just have to master, and without it, you could massively increase the amount of time that it's going to take you to reach financial independence. And that's why you really should watch this video here, where I show you the most important investing tip I know, which will help you reach financial independence as soon as possible.
I get it.